Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Yes, good morning. Welcome to the U.S. Market Update. The Nasdaq Composite closed at a record high on Monday as investors geared up for a data-heavy week that includes two closely watched readings on inflation. The tech-heavy Nasdaq finished up 0.45% to close at 21,798, a record high after hitting a new all-time intraday high in the session. The S&P 500, meanwhile, settled up 0.2% at 6,495, while the Dow Jones Industrial Average rose 114 points, or 0.25%, to close at 45,515. The move higher was led by a rise in shares of chipmaker Broadcom, which gained 3%, and AI darling NVIDIA, whose almost 1% advance reversed some of its steep losses from the past month. Amazon and Microsoft were also higher. Now, to check in with how markets are moving, we've got on the line Alex Morris, CEO of FM Investments. Alex, how are you? Thanks for coming back on the show.
Thanks for having me back.
Yeah, let's talk about the performance in the markets. Not too bad a start for September, given that this month is historically weak for markets, right?
Absolutely. September tends to sort of surprise people. Usually they're expecting everyone to get back to work and asset levels to rise, and that historically isn't the case. This year, absolutely. New highs happening all the time, and it seems to come in the face of, somewhat questionable economic data and concerns about, the stability of the Fed. And yet, here we are, new highs seemingly every day on the back of AI, but also some other, pretty positive equity trends as well.
Yeah, let's talk about the AI spend. There seems to be great momentum on that front with regards to AI infrastructure build-out. And it's not just concentrated in the Mag 7. So we have shares of Nebius Group soaring more than 60% in extended trading on Monday after the provider of NVIDIA graphics chips for training AI models said it signed an agreement with Microsoft worth up to $19.4 billion. And this, of course, comes off the back of Broadcom's $10 billion AI chip order from OpenAI. So it seems like the party is spreading beyond the Mag 7 on the AI front.
Absolutely. For folks who've been talking about the AI revolution, this is exactly what they've been talking about and waiting for. This is an ecosystem build. It isn't just one or two companies who will benefit. There's a great number of companies outside the Mag 7, outside the S&P 500, who really stand to make some great innovation here. That said, we also worry a little bit about, history tells us when this gets a little too hot too fast, that's usually time to call a top. But this one feels like the AI revolution has been in the making for a long time. This feels like it's got some sustainability to it. The names are going to come and go, right? We're going to see the pets.com of this too. Don't worry. But for the time being, the investments here are real and they're very sustainable.
Let's look into now what we can look ahead to for the week. We have two key inflation readings, the CPI and the PPI. What are your expectations on that front?
And we think inflation is going to come in sort of at expectation or slightly below, just as it has the last few times. Our sort of bead, the market's bead on where inflation is, seems to just be a little off from the numeric reality. But we stand by the belief that you hear from the Fed and that we've had for a long time, that it feels like from an economic standpoint, there should be more inflation in the system. And we're going to see that at some point. We just don't think those readings are the ones that are coming. The backward-looking factor of this over the last few months has been working against inflation coming in hot. Oil prices have come down. We see more production coming online. So some of the major contributors just haven't been there for shock upside readings. But we do think that it will come in. We think PPI in particular, so we're talking about producers here, not consumers, they have been less able to pass on inflation that they actually did experience over the last year with every month we go forward. So we expect to see that gap, start to really close as manufacturers have to either pass those prices on to consumers or accept lower margins. And we've seen that they are unable to sustain lower margins for a long time. So we think if anything surprises, PPI will be a little hotter, but CPI, at or below as we've seen the last two prints.
Fair enough. How might persistent inflation, despite the Fed's actions, impact future economic conditions, you think?
It would be problematic. We forget, I think, as an investor base, that inflation isn't a Fed issue and it's not a central bank issue. It's a generational issue. Like inflation that becomes persistent and ingrained, particularly when wage growth starts to get out ahead of it, is really hard to tame without a deep period of even higher rates than we've seen today. And not taming it is a problem. If you have to start handing out 2 to 3% pay rises every year just to keep people flat, all of a sudden the price of goods starts to spiral out of control. So I think we've agreed with the Fed's movement to step in and squelch inflation now, but we hope that they will not come off that, and central banks across the world won't come off that until inflation is actually truly resolved. Because the only thing worse than not resolving it is watching what happens when the tools you try don't work and people lose faith.
Yeah, Alex, we were looking at potentially 2 cuts before year end, but now I think some traders are pricing in potentially 3. What are your thoughts on that matter?
We're still at 2 cuts, 25 each. We thought this coming before the news, before Lisa Cook, before other things. We thought the Fed had forecasted very well. That was there. The jobs numbers were a little weak. Let's face it, the jobs numbers the last 6 to 12 months have had some real instability and lack of predictability to them, and maybe some revisions that make us question if the methodology is consistent with market conditions. But we don't see any reason for the Fed to change that. There's no shock news that would bring them off their well-choreographed plan. And if nothing else, the Fed under Jerome Powell the last few years has been all about trying to choreograph to the market exactly what it's trying to do to avoid surprises.
Yeah, how do you think the ongoing conflict between the White House and the Fed may impact the Fed's independence going forward?
I mean, it certainly is deteriorating it one bit at a time. If Lisa Cook is fully removed and the president can appoint just courtiers to the Board of Governors, they could more or less hire and fire the regional presidents at their whim, which really does remove most of the inherent independence the Fed has. That said, the Fed's boss still remains Congress, not the president of the United States. And over time, Congress does have a reasonable ability to assert its will when it needs to. It would be problematic. The governor that seems to be appointed is coming in is not actually going to take a leave of absence from the White House, which creates a very interesting dynamic of he may not be able to actually see all the economic data he needs to see because of his White House clearance for other data that he needs to be able to see. So we're seeing that deterioration in real time. The question is that loss of independence going to affect the outcomes that the Feds can derive in the next 6 months? Maybe not. But this is an issue that we'll need to keep an eye on to see if it can be restored appropriately for the next 6 years and well beyond.
So suppose rates are cut at the next Fed meeting, which seems very, very likely. How can investors position themselves to take advantage of that and the widening high yield spreads?
We've seen high yield and corporate come in to be priced to perfection. So if you've been in, you've had a great ride. If you think spreads are going to blow out, you probably want to stay away for a little while and then come back in. Your cash is still paying well. We're talking about a 25 basis point cut here, not 250. So if you've been in cash and you want to take that opportunity to just stay there, things are going to be okay for you. But we do like adding duration this time. This is a great time to be looking at the middle end of the curve. The 10-year looks good. Corporate debt that has, longer duration looks like a great opportunity to get in. If you think that's going to happen, this is the time to do it. You can't try to make that trade the day of the Fed meeting because of all that choreography that goes on. The market tends to price all of that in a week or so beforehand. So this is your chance to really make that move. Way too long and it'll evaporate. That said, also, if spreads come down, you are going to see some equity market enthusiasm. If this isn't enough enthusiasm for you already, you're going to see a lot more equity market enthusiasm for a short while. So time to maybe load up on some large cap stocks as well.
Yeah, I was just about to say, you're probably recommending a diversification in equities over a concentration, given how potentially volatile the market can be. But Alex, thank you so much for your time this morning. We were in conversation with Alex Morris. He is the CEO and CIO of FM Investments. Thank you so much.
Thank you.
All right, take care. Have a good one. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.